Hey friends, this is Mayhem coming to you on Monday, January 24th. Just wrapped up my trading day, so I figured I would share what I'm seeing and talk a little bit more about the Fed meeting that's coming up. I want to do this as a video for the entire community out there because I know a lot of people are nervous and justifiably so given the price action that we've had. This has been the worst start to a year in about 90 years for the S&P 500. The NASDAQ obviously hasn't existed that long, but it's been basically mirroring some of the action that we saw during the dot-com bust in terms of down more than 1% every day in a row for many days. We see carnage underneath the surface, really across multiple sectors. If you're in this market, you're wondering what's going to happen next. And really, that comes down to the Fed. Earnings are important. Geopolitical developments are important. Macroeconomics are important. But ultimately, this is a globally synchronized liquidity bubble across multiple advanced markets, and the central banks of the world, most importantly the Fed, have had an outsized role in creating this bubble, in manifesting the price action that we've seen, even all the way back to March of 2009, where the great financial crisis bottomed, and we saw a rather extraordinary intervention by multiple authorities, including the Fed, but also FASB, who suspended mark-to-market for banks who had all this insolvent, unclearable mortgage-backed security paper on their books and said, hey, you can mark it to whatever you want. And that's what I called mark-to-make-believe. Between mark-to-make-believe and quantitative easing, we built this new bull market. The government obviously played a role too with things like TARP and so forth, but that was a smaller role than what the Federal Reserve ultimately had done. So when we look at the futures today, we could see, they're off their lows, but they're not looking so great. You have the Russell kind of flat on the day, which is a little surprising given that it's such a sensitive index to negative flows in the market. You can see it's coming down just a little bit more here now. But overall, just across the board, it really started in Japan and then Europe and then the United States. You've got a market that's being routed. It's down over 2% across every single major index except for the Russell 2000. You've got crude, which also seems to be putting in a little bit of a top here, at least short term. Other commodities are holding up better. Surprisingly, gold is actually kind of hanging in there today, while silver, platinum, copper, all seeing some downside pressure. So it's a mixed picture across the commodity complex. For whatever reason, lean hogs are up 10% today. I don't know the news out there. If you guys follow that, you're welcome to share it in the comments. VIX is up almost 10% today. Ethanol 2.78, palladium 1.93, and the rest is pretty meh. And then lumber down 3.93%, Euro stocks down 3.67%, so really bloody over there in Europe. DAX down 3.14%. So you can see that equities are really starting to price in an environment where the abundance of liquidity is not so plentiful, where there is a tightening, and when there's also this notion of a global economic slowdown. So it's kind of a double whammy because, sometimes when the Fed is normalizing policy, you can see that they begin to, do so in an environment where the economy is strengthening significantly as to sort of pull back the liquidity so that the economy can run on its own. We're not really in that kind of a situation here. The economy is not as healthy as it has been during prior periods where the Fed was hiking rates. In fact, if you net out all the stimulus, fiscal and monetary, and all the inflation, this hasn't been much of a recovery at all. And that's a problem. Because if you go and you start raising the cost of capital and slowing an already slowing economy by raising rates and engaging in quantitative tightening, it could set off a rather profound slowdown and cascading crash in the stock market. And I use those words not lightly. If the Fed actually engages in quantitative tightening with a $1 trillion a year plus runoff from their balance sheet, where they're actively selling assets, that will bring about a prolific bear market. There's no two ways about it. This entire liquidity bubble was driven by an enormous amount of central bank liquidity flooding the system. That reduced the cost of financing, but it also created this abundance of liquidity that was seeking returns. If that goes in reverse, then what you see is companies are not going to be able to afford to borrow to buy back their own shares at the same quantity. People will have to scale out of margin debt, and there's a high correlation of margin debt and stock market performance. And that you'll see that there's not as much liquidity chasing returns. And in fact, you could also see that in longer duration debt, the U.S. sovereign debt, that real rates could go positive, and that could make that more attractive. There could be an alternative. We could get out of this sort of TINA, there is no alternative market. So there's a lot of confluent factors that are happening behind the curtain here, and they're important to pay attention to. So outside of what's going on in the markets today, let's just take a look at global debt. In 2020, global debt experienced the largest surge in 50 years. We're certainly not slowing that process down too much. We haven't seen as much spending planned for 2022, but 2021 was kind of a banner year of spending. There was a lot of stimulus in the system from the fiscal side. And we can see that this is a debt level that is in all likelihood unsustainable. This is 256% of global GDP. So that's not something that you want to have running for a very long time. You know, if you can't pay down that sort of a debt, what it creates is the possibility of a default or debasement of currency, or basically debasement being a soft default. Because what we have here is an inordinate amount of global debt at a time when central banks are saying we're going to stop essentially monetizing this debt. We're going to stop keeping interest rates low enough that this debt is not a systemic risk. They're saying we're going to increase rates, and in the Fed's case, we're going to also be doing QT. Now, obviously, the ECB is not in that position. The Bank of Japan is not in that position. The People's Bank of China is actually reversing and going more dovish. So it's really the Fed, the Bank of Canada, Bank of England, and some of these others that have been more aggressive. But it still matters because the Fed is sort of the eye of Sauron in this situation. And once it starts going towards that tightening, it becomes incredibly problematic for risk assets and for debt assets, and really even for things like real estate, because the cost of funding is going up and liquidity is leaving the system. And that's what made this entire run from, let's call it 195% debt to GDP to 256% debt to GDP. That's what helped to make it possible, is central banks really monetizing that global debt, especially in the countries that were engaging in more aggressive quantitative easing and other sorts of stimulus. So this is a debt level that concerns me a great deal in a world of normalizing central bank policy. So the question is, can they really normalize central bank policy? Well, let's go home and look at our own debt. Here's the debt of the United States government, approaching $30 trillion. And in a very short time, I might add. I mean, we were just over $5 trillion of debt after 2000. So we've almost six-folded our debt in, just over 20 years. That's incredible. And I know the economy has grown, and that's good. But the amount of debt that we've taken on is one of the reasons the economy has grown. We're spending something like $7 of debt for every $1 of GDP growth in terms of the efficacy of fiscal stimulus to grow the economy. It's not efficacious. It's problematic. And yet, during the COVID crisis and also during the great financial crisis, inordinate amounts of debt were taken on to try to stave off a collapse. And the problem is, when you have more and more and more and more and more and more debt, you have more and more and more and more rate sensitivity to that same debt. So if interest rates are to normalize, and I don't just mean the Fed funds rate, but I mean the Fed really taking the foot off the gas, fully ending their taper, engaging in quantitative tightening, selling assets off their balance sheet, the entire fungibility of the U.S. government gets called into question. And that's an issue too. How can the government fund itself if interest rates are going up at a point where the interest on the debt paid starts to become a huge budget item? So let's just talk about the 10-year bond for a second, right? Let's say the 10-year Treasury note goes to 2% and we have about $30 trillion of debt. That means it's a $600 billion a year deficit spend on just the debt. The DoD budget for 2021 was just about $740 billion. So you could see we're approaching an interest service on the debt that would be similar to that of the DoD budget. What if we go to 3% on the 10-year, which many people are calling for this cycle? Well, that's $900 billion a year of deficit spend on interest alone. And we have to remember that the Fed, when it does QE, it's actually paying back the interest on the debt that it earned to the Treasury every year. So it's effectively monetizing the interest on the debt, monetizing the debt itself. Like it becomes like, you got a free credit card from Best Buy. It gives you 12 months, no APR. That's kind of what's happening with the Fed right now. The Fed has become a sort of credit card for the Treasury to borrow money and not have to pay the interest back. So that's a concern, because when the Fed talks about ending QE, that goes away. So that's not really being factored for in sort of conventional thinking about how drastic a change is from QE to QT in an environment where the government wants to continue spending money like a drunken sailor on some of these fiscal programs like Build Back Better or whatever iteration comes later from it. It's also from a macro standpoint, very foolish for the government to consider spending so much money towards the end of an economic cycle. It's basically ammo that's being wasted that would be needed during a recession, which may not be far away if the Fed does what they say they're going to do. So this is important to monitor the total debt out there, especially as it concerns the U.S. government, and then also the $150 trillion plus debt tranche that keys off the 10-year interest rate. So, you see 10, 20, 30 bip moves causing hundreds of billions of dollars of losses, even more than that, as time goes on. Now let's look at the U.S. 10-year Treasury yield. And we're going back quite a ways here. We're going back to 1990. Okay, and we could see that this is just a channel of, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. It just keeps on going, all the way until the COVID crash, where it got to sub-zero, and then it's bounced back, more than tripled from its low over the summer of 2020. That's important because we really have this upward channel here. This has been, by the way, in effect since the 80s, this sort of downward trending yield. If we actually meaningfully break out of this downward trending yield channel, that's going to be a big problem for the fungibility of debt all over the world. A 10-year bond over 2.5% not only potentially breaks this downtrend in yield, but it puts the fungibility of the U.S. government and, over $100 trillion of global debt into question. It causes enormous losses. The credit markets would be less stable. And this is also not even taking into consideration the sort of breaking down of what's happening within the Chinese real estate market, which is a $95 trillion market. It's the biggest market of any asset class in the world, and it's also quite rate sensitive. And even though the Fed isn't directly connected to China, if they do start to pull back their liquidity, it has effects globally. And the Chinese authorities have even told the Fed, you shouldn't tighten too quickly. And I don't think they're saying that because they want to play a game of chicken. I think they're saying that because they're legitimately concerned that their economy could implode if we see liquidity conditions meaningfully tighten with so many of their debtors in the real estate market in very precarious shape. This is a chart of the S&P 500, and it's as recent as this video. The concern that I have here is that if we can't hold this 4,300 level, if we can't really hold these October lows, and it looks like where the futures are right now, we're not going to, that it sets us off for the path of least resistance being meaningfully lower. And this is directly correlated with the fear that's out there regarding the growing sort of consensus that the Fed may indeed live up to their promises. The triple threat of accelerated taper, accelerated rate hikes, and accelerated balance sheet runoff. That's the magic elixir that kills risk assets, and the S&P is telling us that in no uncertain terms. It is down now quite a bit year to date. It's essentially had the worst start, as I said, of the stock market since the Great Depression, start to the year. This is something that bears monitoring, because if this cascade continues, it feeds on itself. You have people getting cleared out of margin and other leverage positions like options. People are closing them out in a panic. You have the potential for it to bleed into other types of asset classes too. Certainly if there's a risk-off environment that assumes that the cost of debt is going up, then everything that's sort of tied to that, like high yield, could start to blow out as well. We haven't seen that stress grow significantly yet, but we are seeing some signs that people are starting to get concerned out there. So it's something to pay attention to. The stock market right now, as we see in the S&P 500, is precarious. It is vulnerable. It is essentially in a situation where if the Fed does not make a dovish pivot on Wednesday, that it could become somewhat calamitous. If the Fed comes out more hawkish than the market expects on Wednesday, I expect another leg down of selling, and I would expect that leg down of selling would continue. It wouldn't be just a one-day event. I could completely be wrong. This is just me sort of spitballing with the data I have in hand, but this is a market that is essentially through its price action pleading with the Fed, saying, the liquidity you've provided is the lifeblood of this market. If you take it away, we are going to go into a vicious bear cycle. And there is a lot to back that up, including what happened from 2017 to 2019 when the Fed did their first attempt at quantitative tightening. The market had something like 18-19% sell-off in December of 2018, and it wasn't making new all-time highs until the Fed backed off their quantitative tightening and stopped it and even began to reverse it. So that's the situation we're in this time, except for the market is front running that outcome. It's already starting to sell off before the Fed has taken those actions. The market's forward looking, and it doesn't want to, people don't want to get caught in a situation where indeed the Fed is draining the pool of liquidity that has boosted all of these asset prices higher. And if you think about it, it really is a good visualization. QE is like a spigot. You're filling a pool, you've got all these beach balls, those are the stocks. As the liquidity in the pool rises, the bid for all those beach balls, those stocks rises up with it. And when the Fed says we're going to slow QE, what they're doing is they're starting to cut off the spigot, right? Still flowing water, but they're starting to cut off the spigot. Once they start to talk about rate hikes and quantitative tightening, they're draining the liquidity out of the pool. And that's where it becomes a big problem for equities. So that's what we're looking at right now. But what's also very interesting is that there's a strong correlation between inflation and in the Fed's preferred measure, the personal consumption expenditures index, and the stock market's performance. And that's something that's worth watching. Now, obviously, there's a little bit of chart crime going on here. I'm just trying to show the positive correlation. It doesn't mean that they're tied one to one. But what it does show us is sort of upward pressure on the cost of consumer goods and services is bullish for the stock market. And when the Fed gets concerned about those things and says we're going to battle inflation, they also mean asset inflation. They may not say it, they may not necessarily imply it, but that's the net result. Because when you battle inflation, you do slow down the appreciation of risk assets, if not reverse their appreciation. That's important to note. So I do think it's important to keep watching these econometrics, in particular the PCE, because that's the Fed's preferred measure of inflation. And if we do see a meaningful rollover in the velocity of inflation, it could have a negative impact on equities. We could see that the total assets of major central banks have grown, but the velocity of those balance sheets has shrunk significantly. So here's the total assets of major central banks here. We can see that post-COVID reaction. It was very, very strong velocity until it peaked out. And over here, we can see that the total assets of major central banks as a yearly percentage change, it's rolling over, right? And when did it start to really roll over? The beginning of 2021. What else rolled over in the beginning of 2021? SPACs, EV stocks, China tech, biotech, small and mid-cap growth. Nothing really recovered from that roll-off. Well, why did it run and why did it roll off? Well, you could see it ran because the velocity of central bank liquidity was so high that money was literally flooding the system looking for returns anywhere it could find. And as that money slowed, didn't get removed, just slowed. The velocity slowed. You could see that the assets of major central banks still very high, still at very elevated levels, right? Just peaking in terms of the growth. Well, that fall off impacted all those highly speculative assets just the same. But here's another area of interest. Look at what happened to the velocity of central bank balance sheets going into reverse, shrinking in the 2018 to 2019 debacle that was quantitative tightening by the Fed, right? This was the attempt at normalizing the Fed's balance sheet, which led to a rather significant rout in equities. And now they're saying they want to do something like that to a much, much larger extent. Remember also, Bitcoin crashed as the Fed started to do their balance sheet runoff, right? I mean, let's pull up a little chart of that, shall we? Let's pull up a little chart of what happened to Bitcoin when when the Fed did their balance sheet runoff. Because I think that this is something, if you're in this stuff, I've said it could be one of the most vulnerable asset classes right now. We're just going to take a quick look at it. It's not meant to be financial advice, by the way. I'm just putting this out there because I think that some people could use a little bit of additional information about what's going on and why these things have moved. And so here's a chart of Bitcoin in that time period. And right here is in 2017, the Fed started to talk about QT and really started to effectuate it. And we could see that Bitcoin had a rather nasty reaction to QT. And it wasn't until QT was really reversed that Bitcoin caught a bid. So let's just take one other indicator. I can't put the balance sheet of the Federal Reserve on this chart, but I can put Fed funds, which is another kind of way of just measuring the tightness of liquidity. And I'm just going to put that below. So hold on a second. Sorry about that, guys. I've got to make sure I put in the right thing, and that's going to be Fed rate. Okay? So here's the Fed rate. What do you notice? Bitcoin doesn't like the Fed rate going up. You see that? When the Fed rate went up as a part of their attempt to normalize, and this was also when they were doing QT and selling off assets, Bitcoin hated that. So this really is showing you crypto is fundamentally tied to the abundance and cost efficacy of acquiring liquidity. If you don't have cheap liquidity, you don't have an abundance of bids for crypto. That's really important to consider. I know a lot of people are very deep into this stuff. What you have to ask yourself in the event of a situation where credit tightens meaningfully is, what is it worth? How do you value it? Do you even know? If you don't know, then how can you determine what a fair value is to buy or sell it? And how much of the price of Bitcoin is based entirely off faith and not any fundamental factor? So as rates rise, we could see that Bitcoin could handle it for just a little bit, but balance sheet runoff and rate hikes really do hurt the sentiment in this space. That's important. And let's just take it now into today so I could show you just what I mean. Let's go to the end of 2021. See what happened when the Fed rate went zero and we saw that wall of liquidity enter the market? Bitcoin bottomed and ran. So again, be careful about normalization. All this crypto is incredibly vulnerable to normalization, in my opinion. Now we're going to talk about a couple more things, and I'm going to come to my conclusions here. Thanks for tuning in. Thanks for staying tuned. If you listen the whole time, this is kind of like a lecture, and I know it's a lot to take in, but it's not easy to explain. The charts are important. The length of just discussing all these things is important. So this is the projection for the January 26th Fed meeting coming up this Wednesday. It is that they will stand pat. There's only a 3.1% chance being priced in that they're going to raise rates by as much as 25 bips. We go to March. It's a different story. The presumption is that 86.7% chance that the Fed is going to raise by 25 bips. You go to May. People are kind of mixed. Maybe they'll hike to another 25 bips higher from there. Maybe they won't. June, starting to see a little bit more certainty. July, a bit of an even split, but we keep pushing up. You can see we keep pushing up as to where the rate's going to be, right? September, looking like we might get to 1%. November, but what we don't see here, we don't see people really pushing it too much further, right? So maybe we get to 1 to 1.25% in December of 2022. So this is not pricing in an aggressive rate hiking schedule from the Fed, and yet you can see the reaction in the market. right? So this is with the market not really pricing in everything the Fed's talking about, unless their 4 or 5 rate hikes are just 25 bips. Maybe it's starting to price that in for 2022. But you can see that the equity markets are extremely concerned about the prospect of rate hikes, of QT, of even accelerated tapering. So what happens next? So let's go back to this chart of the U.S. government's debt. Let's say the Fed does everything they say they're going to do. What does that mean for this chart? What does it mean for the fungibility of the U.S. government's debt? You know, you have people in the legislature talking about new bills. We're going to pass new bills that is going to spend more money. Well, how are they going to fund that if they're spending so much interest on the debt as the Fed normalizes and rates rise? It's unlikely that they can. Right? The other thing is, what happens if interest rates rise on the longer dated maturities more than the shorter dated maturities? Is the government may start to try to fund more of its debt on those shorter dated maturities, and that could cause a little bit of a yield curve flattening, or even an inversion if they load too heavy there. Now, I'm not trying to predict the future, what's going to happen in credit markets. I'm just mentioning possibilities. But what really concerns me about all of this is the Fed doesn't have the flexibility that they've articulated. They can't fix these problems. In fact, they've even admitted that the Fed can't fix supply chain inflation. They can't fix the supply chains. So that's a problem, because supply chain inflation is one of the core drivers here. One of the other core drivers is the demand that was driven not by Federal Reserve policy, but by fiscal policy, just basically helicopter money, which is all but gone now. I mean, it's pretty much, they've stopped doing the majority of that. Student debt moratorium ends in May, so that's pretty much the last respite of that stimulus. And so what can the Fed really do? They can talk a tough game, and they are, and they're probably gaining some policy outcomes, completing some of these goals just by scaring the market, right? They've done a pretty good job. They've scared the risk out of risk assets, right? They've scared the greed out of risk assets. They've promoted the risk in risk assets. They feel riskier than they have for 2 years, right? So if the Fed does what they say they're going to do, which is, let's say, 4 to 6 rate hikes, accelerated tapering of QE to the point they're done by March, and quantitative tightening in excess of $1 trillion a year. If they do those 3 things, then we're in for a brutal bear market. In housing, in stocks, in bonds. I don't believe that some people are saying that quantitative tightening is good for long bonds. I don't believe that view at all, especially when the Fed is 40% of every 10-year auction, when they are the biggest single-party buyer of U.S. debt, when you see the fungibility of U.S. debt go pretty far into the territory of counterparties being skeptical if the Fed pulls back completely and also begins to sell their balance sheet down. By the way, the majority of their balance sheet is treasuries. It's much smaller for mortgage-backed securities. So there's been some talk that QT will be good for long bonds. What might be good for long bonds is a extreme slowdown and recession. That might be good for long bonds because people will fear buy into them. But QT itself is bearish pretty much every asset, because it is the elixir, it is the liquidity that drove rates down, that bought an outsized amount of bonds, that helped to push money into equities, creating that there is no alternative TINA trade, that pushed money into the housing market because mortgage-backed securities were being bought such that, real estate lending, mortgages themselves, the price of the interest on that kept going down and down and down, and that let the price of houses go up and up and up. A lot of people own houses they can't afford right now in a normalized interest rate environment, which begs the question, what happens to the price of that house if rates normalize? And then how many people are going to be underwater because what they owe, their equity, is negative? This is a lot like the great financial crisis in that sense, in that housing had this enormous run. A lot of people bought a lot of houses, and if rates normalize, they're holding bags because they won't be able to sell at those prices because people can't afford those prices because they were only made possible by artificially low mortgages, those rates. I mean, it's the same thing in the equity market in a sense. You know, you create no alternative. You tell everyone they have to buy equities because there's no yield to be had in sovereign duration. That it's all riskless or return-free risk, right? If all that stuff is return-free risk, what happens? What happens to your your investment in a treasury, right? You buy a treasury. Let's say it's a 30-year. Let's say it's yielding 2.96%, but then the real yield is minus 0.12%. You're paying the government to own that bond. So a lot of people haven't really wanted to do that. Like the people that are buying bonds are institutions that either have to, or it just is part of their risk management framework, or maybe they are balancing a portfolio where it's 60% equities, 40% bonds. There's a lot of situations where institutions have to own that stuff. But as an everyday investor, why would you want to, right? You're literally paying the government to hold their debt when you adjust it for inflation expectations. But if rates go higher, that paradigm changes, and all of a sudden fixed income might start to become more attractive if these things start to have positive real rates. And that puts pressure on equities because it's competition. There is an alternative, right? If indeed that outcome manifests. So I don't personally believe that the Fed can go as far as they've said they can go. And I don't believe that they can for one simple reason. They will destroy the global financial system. In no uncertain terms. It would completely tear down the bond market, the stock market, the real estate market, and other peripheral financial markets. It would tear apart commodities and crypto. Yeah, like there's over 17,000 coins out there with a $1.6 trillion market capitalization. That would be wiped out. There would probably be a handful of winners, and the majority of it would be gone. Because a lot of it's funny money and you can't value it and you have no idea what these things are worth and what they do and the use case. And that starts to matter a lot more when liquidity conditions are tightening and people start to ask themselves those hard questions. So pretty much every asset class is vulnerable, right? Cash becomes king in that kind of environment, truly becomes king. Is the Fed going to go that far? Are they going to effectuate their triple threat? My thought is they will accelerate their taper. They will probably do 3 to 4 rate hikes. They'll start QT, but it's going to go very poorly. And they're likely to have to reverse. Now, I'm going to leave you with one last thought. And this is something I have to pull up, so bear with me here. Bear with me here in terms of just getting this out here. Okay? So this is from the British Parliament. This is a study by the House of Lords. And what it really is saying is that every central bank in the history of QE has never fully managed to unwind quantitative easing. I'm going to read this quote. It's here. You can see the link I'll include in the video in the description. But I'm just going to read this out, and I'm going to end my video here because this is really my thought about how this goes. This time is not magically different. You know, they either destroy the global financial system or they, in any game of chicken, veer out of the way at the last second. I think they veer. I could be wrong, but I think they veer. No central bank has managed successfully to reverse quantitative easing over the medium to long term. In practice, central banks have engaged in quantitative easing in response to adverse events, but have not reversed the policy subsequently. This has had a ratchet effect, and it has only served to exacerbate the challenges involved in unwinding the policy. The key issue facing central banks, as they look to halt or reverse quantitative easing, is whether it will trigger panic in financial markets, with effects that may spill over into the real economy. The Bank of England is unclear on whether it intends to raise interest rates or unwind quantitative easing first when it decides to tighten monetary policy. In 2018, the bank suggested tightening would come first in the form of higher bank rates. More recently, the governor had suggested unwinding quantitative easing might be first in any tightening. The rationale for reversing the order in which policy is tightened is yet to be fully explained. And we are concerned that the bank does not have a clear plan. This is concerning considering the renewed debate around inflationary pressures. So this study, and it's obviously not current, but the results are. This study is from 2021. And it's saying that no central bank has fully reversed their QE. None. And they're right. I've checked too. I mean, not that I would doubt their work, because Parliament in the UK does pretty good research. But this is true. No central bank has ever fully reversed it. So what happens with this global game of central banking chicken versus every asset class? I think that ultimately they do have to step out of the way, because here's the other side of it, right? They can say they're fighting inflation. They don't have the levers to pull to do that. The Fed can't pull a lever and stop a port in China from closing. They can't pull a lever and make up for the deficit in copper supply. They can't pull a lever and engage in years' worth of oil and gas exploration that we might have needed if we weren't going to have this sort of energy shortage. They can't pull a lever and fix the trains and freight issues and other kinds of problems in the supply chain. They can't pull a lever and really fix the labor market. So all they can do is pull levers that slow the economy, increase funding costs. That's really the levers that they have to pull. And as they pull those, it actually creates problems. Like if the supply chain issue is bad now, what happens to these same companies if their funding costs go up? Are they not going to pass on that increased funding cost? Is it not possible that a normalized rate environment could actually increase cost push inflation? Sure, it will kill demand, and that will help, but it doesn't resolve the structural problems, the imbalances that are existing in the economy, in the supply chain. So on the other side of it, you have this debt supercycle. You have hundreds of trillions of global debt that, if it becomes non-fungible, the entire house of cards that is the financial system begins to fall apart. And I don't use those words lightly. I mean exactly as I've said them. This entire regime, this stock market bull that we've had since early 2009, when the bear market bottomed, we started to see upward price appreciation. It is a liquidity bubble. It is driven entirely by central bank liquidity. Yes, earnings matter. Yes, buybacks matter. But a lot of those things are byproducts therewith, because the central bank liquidity is flooding the economy and creating demand too. So if you take that away, the earnings go down, the buybacks go away, the margin speculation goes away, the stock market goes down, the real estate market goes down, the crypto market goes down, and in a lot of ways, the bond market goes down too, especially in the riskier parts of it. So, in summary, I don't believe they can do everything they've said they are going to do, but I do believe they are foolish enough to try and get to the point where it becomes abundantly clear that they're breaking the system and then pull back. So we're not quite there yet. The markets are scared because they're realizing the same thing that I'm saying, that they are foolish enough to potentially try to break the very system that they've expended there's no limit to the amount of money they've expended essentially to try to save it. Remember in 2020 when Jay Powell said unlimited QE, we will pull out all the stops and do everything possible to save the system. Why would they put that much effort into saving something they ultimately would destroy? So the question really is, how far are they going to push? It's not whether they're going to push, because they seem intent to do that. It's how far. So I think it's very important that we watch the January meeting this Wednesday, the March meeting that's coming up, the econometric data in between, earnings as well. PCE is coming out this week. That's going to be important to watch as well. That's the Fed's favorite measure for inflation. So please be careful out there. This is not a time to be making rash decisions going long or short for an extended period. If you're day trading, you know what you're doing, that's a totally different story. If you're trying to make longer term investment decisions right now, we have more uncertainty than certainty about directionality. Short term, the path of least resistance is down in equity markets. But longer term, what happens next is going to have a lot more to do with central bank policy than pretty much anything else. And my take is they have very few options to tighten as much as they have said that they will. That in doing so, it's going to be extremely dangerous for the global financial system. It doesn't mean that they might not try, but I do think that eventually they will pull back before they eviscerate the same system that they tried to save. I hope this is helpful. This is just a summary level sort of overview, lecture, whatever you want to call it, about what's happening, why it's happening, and where we might go from here. Until next time, this is Mayhem signing off. If you like this video, please like and subscribe to my YouTube channel. If you're a trader or an investor and you're having a rough time out there, you need a little bit of extra help, check out Trader Aid. We provide resources on a subscription basis. I also do one-on-one coaching for investors and traders. Check out my website, marketsandmayhem.com. Check me out on Twitter. My handle is Mayhem for Markets. Until next time, this is Mayhem signing off.